This video reviews Mitsubishi UFJ Financial Group's third quarter financial results for fiscal year 2025. Like the other mega banks, MUFG performed well, posting both higher revenue and higher profit. Let's take a closer look at the performance. A quick overview, Mitsubishi UFJ Financial Group is Japan's largest bank holding company. It is one of the three Japanese megabanks, alongside SMFG, Sumitomo Mitsui Financial Group, and Mizuho Financial Group. For the 9-month period, net operating profits reached 1,905.9 billion yen, up 19.5% year-on-year, achieving 84.7% of the full-year target. This growth was mainly driven by higher profits in the customer segment and improved interest income, including positive effects from the rebalancing of last year's bond portfolio. Net income amounted to 1,813.5 billion yen, up 5% from the previous year, supported by steady growth in net operating profits and increased equity earnings from equity method investees. The progress rate toward the annual net profit forecast is 86.4%, reflecting steady performance. For the first 3 quarters, gross profits increased to 4,469.1 billion yen, up 8.4% year-on-year, supported by overseas acquisitions. The positive impact of higher yen interest rates improved interest income from last year's bond portfolio rebalancing, higher fee income from domestic and overseas loan and solution-related services, and reduced losses on bond sales. Foreign exchange movements also contributed positively. G&A expenses rose due to the impact of overseas acquisitions, inflation, and strategic investments for future growth. Despite this increase, the expense ratio improved, reflecting better cost efficiency. Net operating profits increased year-on-year. Total credit costs improved, staying within the initial outlook despite large fluctuations in loan loss provisions. Profits from stocks fell compared with last year, but earnings from investments in other companies rose, driven especially by strong results from Morgan Stanley. As a result, net profits rose to 1,813.5 billion yen, up 8.3% year-on-year, marking a historical high for Q1 to Q3 results. The total domestic loan balance grew steadily during the period, driven mainly by lending to large corporations and small and medium-sized enterprises, SMEs. Housing loans remained stable, and lending to governments and related entities showed little change. Domestic lending rates have gradually risen, while deposit rates increased more slowly, keeping the gap between lending and deposits favorable and supporting interest income. Corporate lending spreads also showed modest increases, reflecting improved pricing power, particularly for large corporates and SMEs, which contributed positively to profitability. The overseas loan balance grew steadily during the period, with broad-based increases across the Americas, Europe, the Middle East and Africa, EMEA, as well as Asia and Oceania. The loan balance through overseas bank subsidiaries, including KS in Thailand and BDI in Indonesia, remained solid. Overseas deposit and lending margins remained relatively stable, with a consistent gap between lending and deposit rates in non-consolidated overseas operations, supporting a stable earnings base. Overseas lending spreads also improved compared with earlier periods and remained firm, reflecting disciplined pricing and contributing positively to profitability despite some moderation in interest margins. Holding overseas businesses with higher interest rates is a key strength of megabanks. Non-performing loans declined from previous peaks, and the non-performing loan ratio improved steadily, indicating better credit quality across the portfolio. By region, domestic non-performing loans decreased significantly, while overseas balances, particularly in Asia and the Americas, remained generally stable. Total credit costs improved compared with the prior year, reflecting a net reversal mainly driven by the bank segment, with additional positive contributions from overseas operations. Overall, the improvement in credit costs supports stable earnings and confirms that asset quality remains well controlled. Stock price. This chart over the past year shows the stock price in Japanese yen at 2,949.5 as of February 4. This chart shows the stock price in US dollars at 18.55 as of February 4. Although the earnings results were not bad, the stock had already risen ahead of the earnings announcement, leading to a decline the day after the results were released. As of February 4th, PBR is 1.56 and PR is 15.9. Dividend yield is 2.51%. Compared with the past few years, all indicators suggest that the current stock is relatively high. The share price has been rising recently, pushing the dividend yield lower. Nevertheless, mega banks are expected to expand their businesses further with the Bank of Japan's interest rate hikes, making it a solid investment opportunity. Conclusion: MUFG showed strong results, with consistent growth in net operating profits and net income. This performance was supported by both domestic and overseas lending, higher interest income, particularly from Morgan Stanley, and improved investment income from the rebalancing of the bond portfolio. With the Bank of Japan's ongoing interest rate hikes, mega banks like MUFG are expected to continue performing well.